Welcome to Serious Business on NDTV, 30 minutes of hard business news. One topic, one speaker, and a conversation that's relevant to you. I'm Manvi Sinha Dhillon. The central government presented its interim budget on February 1st. Interim because there are elections this year, and a full budget will only be presented once a new government is formed. That's in the summer of 2024. Nevertheless, the interim budget is important for the data points it contains, for the direction of government policy, and the 10-year stocktake that came through in the finance minister's budget speech. To break it down for us, I'm very pleased to welcome Pranjul Bhandari, Chief Economist India and Indonesia with HSBC. Pranjul, always a pleasure. Thank you for joining us on NDTV.
Lovely to be here. Thanks for having me.
So I'm going to start with the basics first. Your key takeaways from the interim budget, what stood out for you?
Yeah, so I think two things. One, that the government was able to bring down the fiscal deficit. Now, this sounds very academic, but it's very important. The public debt numbers in India have been inching up, and we need to stop that. And the states are also spending a lot now. Over the last year, the state spending has, for example, capex has grown 45% year on year. So you can't have the state spending, the central government spending. Then no money is left for the private sector. So it was very important for the central government to step back a little bit. That's my first sort of takeaway. The second is that it stepped back in a very constructive fashion. It didn't cut capex. Capital expenditure on things like infrastructure. It didn't really cut that. In fact, it increased that. Rather, it wants to cut down on other things. For example, some of its very bloated subsidy bills. So my sense is that the mix of expenditure was also good. So you brought down the fiscal deficit, and what you're really spending on is better quality than before. So it was a good mix.
Okay, couple of interesting points that you've made, and I've been reading your recent columns as well, so I'm going to try and bring all of that together. And thank you for always breaking it down for the layperson who's not an economist and establishing why even a number like the fiscal deficit is important for everyone, all participants in the Indian economy. So we have a lower fiscal deficit target for FY25, a lower than targeted deficit for FY24 as well. What I'm asking you now is, does the math for FY25 sort of look sound because the numbers are impressive? And the second part of the question is, when the government embarks on fiscal consolidation, does that mean that growth suffers? Because the broad understanding for everyone in the public is that the government has been powering growth through its capital expenditure.
Yes, I think the numbers look broadly reasonable to me. In one sentence, the thrust of the budget was that higher tax revenues and lower current spending on things like subsidies will give you enough space to increase capital expenditure on infrastructure and also fund some of the fiscal consolidation, bringing down the government's fiscal deficit. So that was the broad math. Underlying this math are lots of assumptions. What will be India's GDP growth for next year, nominal GDP growth, and all of those numbers sort of look sound to me. Then there are targets for things like disinvestment, 500 billion, fairly reasonable, RBI dividend, PSC dividend to government on the higher side, but we've been getting high numbers for the last couple of years, so broadly reasonable. Overall, the math looked fine to me. So, that's encouraging. By the way, last couple of years, the math has looked fairly, credible. In fact, a little conservative. Even for last year's budget, we've now ended up with a lower fiscal deficit than we had budgeted. So this government is also entering every single year with more conservative numbers and trying to over-deliver by the end of it. So I think that was in a good place this time as well. In terms of the impact of the budget on growth, it's a very interesting question. Economists try to complicate it. We call it fiscal impulse, which is the impact of fiscal policy, the government's policy on growth. When the fiscal deficit is coming down, it basically means the government is having to cut expenditure. It's a drag on growth. So it should be negative for growth, right? But we find that it's not a negative on growth because, yes, it is cutting expenditure, but at the same time, it's spending on better quality stuff, on stuff which has higher multipliers, is more growth accretive. So once you do that, the drag becomes offset. And my sense is that the fiscal impulse this year will be neutral. It will be neither positive as it was in the last few years, but nor will it be negative as a lot of people are fearing. It will be neutral. The good thing about it being neutral is that it also means that it won't add to inflation. So inflation will be under control. And this is, music in the ears of the central bank.
Yeah, which is where I want to bring the sort of RBI in, because if I've understood recent thoughts that you've expressed clearly, as the fiscal impulse moves from positive to neutral, the RBI could be moving on a different path from the one it's pursued in certainly the last 12 months. Again, could you sort of lay it out for us?
Yeah, absolutely. So look, what RBI was grappling with over the last couple of years is very high global inflation, and all the global central banks were hiking rates. Fairly high domestic inflation. India's inflation rate was pretty high. In the last year, we had food prices going up because of the El Nino. And when inflation is high, then the RBI has to keep hiking rates. It has to keep liquidity tight. It basically needs to tighten financial conditions with the hope that over time inflation falls. Now, this has been the story of last year. Enter 2024, and we find that in the first 30 days in January, food prices have actually fallen quite a bit. Vegetable prices, pulses prices. We also find that core inflation, which is, basically the price of the goods and services you consume, is falling. One of the reasons is that oil prices have fallen. So today, manufacturers are being able to cut prices. So all of this is leading to much lower inflation. We haven't seen the prints yet, but this is my forecast. I think in February, the inflation number announced would be 4.5% compared to 5.9% in the previous month. So I think inflation is in the downward trajectory. And now add to this, the fiscal will likely not raise inflation. So all of this together suggests to RBI that RBI can start to ease monetary conditions a little bit more than it was in the past. And by the way, not too many people have realized it, but the RBI has already started easing. It's already started what I call easing by stealth without, shouting from rooftops.
Now, when the RBI pursues this path of just easing below the radar, again, I'm borrowing a term that you have used, which is there is a de facto rate cut effect. Again, I love the simplicity with which you explain what are often put into the basket of esoteric economist talk. So, could you sort of explain how that could potentially play out as well? This whole easing liquidity approach by the RBI, sometimes below the radar completely.
Yeah. So the RBI is in control of two things that matter to financial markets. One is interest rates. It raises interest rates, it cuts interest rates. And the other is the quantity of liquidity that it gives to the banking sector. So one is the price of money, the other is the quantity of money. In the last year, it's used both. It's increased the price of money, it has hiked interest rates, but it's also lowered the quantity of money. Today you talk to bankers and they'll complain to you that liquidity is very tight in India. So that has been the story over the last couple of months. But just a week or 10 days ago, the RBI started to supply some more liquidity in the market. It's short-term money, like it's giving you extra liquidity for 14 days at a time. And after 14 days, it will probably roll it over. But a substantial amount for 14 days, about 2.5 trillion rupees for 14 days, is called the variable rate repo auctions. This has been a huge change in stance for the RBI from what it was pursuing a couple of months ago. And already we are seeing some of the interest rates, the very short-term interest rates, one-day kind of interest rates that have actually come off and are beginning to come off. So the RBI has already started easing liquidity. And if these interest rates come down, and it's just started happening, but if we follow and it comes down, and it stays in low levels for the next 10, 15 days or 1 month, then I think we can say that the RBI has de facto given a rate cut.
And that is a driver of growth in simplistic terms, but can I say that?
Yes, I think so. I think, that's one of the things that helps, growth, people getting access to funding and getting access to funding at cheaper rates is generally good for growth. And this is, I think, something which we have to think together. We have to think about fiscal policy, what the government does, and monetary policy, what the central bank does together, right? I think what we're going to see now, next 12 months, is the fiscal policy take a slightly back seat because, honestly, they've done their job and their now new job is to lower India's public debt. But monetary policy to take a step forward and ease monetary conditions a little bit to be supportive of growth. They shouldn't do too much, but they should definitely do a little more than they're doing right now.
Okay. If you could turn your attention to the rural sector and anything noteworthy from the interim budget, combine that with your analysis of, what's been happening to rural incomes in FY24, and those two taken together, what's the lay of the land for FY25?
Yeah, very interestingly and counterintuitively, we haven't really seen any increase in outlays on some of the rural schemes like Narega or PM Kisan, despite this being a pre-election year and despite, last year being an El Nino year when agricultural production was very weak. And my sense is that what's really going on is that a lot of rural Indians whose incomes from agriculture have been pretty weak last year are getting alternate employment in construction sites. If you look at construction activity in India, it's really on fire. The public sector, the central government, the state government are all doing a lot of capital expenditure, building trains, roads, highways. You can see that on the roads of Mumbai or Delhi. Then there's a lot of real estate demand as well. There's been a huge demand for new housing and a lot of activity there. So a lot of rural Indians are now working in construction sites and sending money back home. And by the way, you can track all of this data. Aadhaar has made it possible. You can track remittances from urban to rural India. And that is why rural incomes haven't been as weak as one would have imagined in an El Nino year. And I think it's literally on the back of that the government did not feel any pressure to really double up, on any of these rural spending schemes.
Not specific to the interim budget, but, drawing on the point you made on rural incomes being lifted by construction activity, how do these construction cycles typically play out, and where are we in that cycle? The reason I'm asking, of course, is because I'm trying to assess what kind of support is going to play out for rural incomes and for how long.
Okay, I'm so happy you asked this question. Things come in cycles. And these cycles are long lasting. They last for 2 to 3 years, and with some luck and good policies, they can last even longer. We were in a down cycle for construction, in the last couple of years before the pandemic. But I think what's happened since then is that a lot of balance sheets have got cleaned up. The banks look healthier, corporates look healthier. Anybody tracking bank credit growth number can see that bank credit growth is on a huge upturn. And this is a financial cycle upturn. Generally speaking, financial cycle upturns, real estate price upturns, construction cycle upticks, they all come together. And I think we are in one of those uptick cycles at this point. Bank credit is growing well. House prices are rising. There's construction activity. And my sense is that this can last a couple of years unless we make some mistakes.
So what mistakes could we make, Pranjul?
If we let the economy overheat, growth is good, but more growth than you can handle is not good. Because what it does, it leads to other excesses. For example, inflation can really go up. For example, your trade deficit, can really go up. So we can have all of these problems. And that's why it's very important for the central bank to ensure that it loosens monetary policy, but doesn't loosen too much, and make sure there's no overheating happen. So I think overheating is our biggest enemy. If we can ensure that we avoid that, this can be a multi-year cycle.
We're going to take a very quick break, Pranjul. When we return, a couple of other trends that, you flagged off and not many have. So that's interesting to talk about, obviously in the context of the budget, in the context of the economy and FY25, but also whether there are more stings in the tail to watch out for. That's after this quick break. Welcome back to Serious Business on NDTV. We're in conversation today with Pranjul Bhandari, Chief Economist, India and Indonesia with HSBC, taking stock of the interim budget, some trends that she's been tracking and how they play into the interim budget commentary, also what they mean for the economy in FY25. And a very important piece that we were talking about was, of course, central bank role, action, and what to expect in FY25. Pranjul, one sort of, I'm sure you, of course, have noticed it, but we don't end up talking enough about states and the kind of spending they've been doing on capex, which is another good thing because this is constructive in expenditure in a sense. What do you make of it? And secondly, are they sort of at their peak because there's a limit on their borrowing?
Yes, I think you're right. For in the pandemic period and in the period right after the pandemic, you found that states were not spending at all. The fiscal deficits they were running was close to about 2%. They can run up to 3%. They could have easily spent more, but they were not. And I think a couple of things were going on. One was that the machinery had taken a bit of a setback in the pandemic years. People not showing up for work, lots of sites, lot of activities closed down in the pandemic. So things took more time to reopen on the state level. And then there were a lot of other issues. There was a lot of revenue uncertainties for them. Remember, oil prices were extremely volatile. And for states, they actually earn more revenues when oil prices are high because they earn the VAT on oil. So they had a lot of uncertainties to grapple with. Finally, they sort of got over all of that. And from last year, they started spending. And when they spent a lot because there was just so much to do. If you're a state which hasn't done any capex for 4 years, you have bridges that need to be built, roads that need to be repaired. So there was a lot of capex activity that happened, and states' capital expenditure on infrastructure grew by 45% year on year last year. So that was quite dramatic. Now with this, the states have gone back to their fiscal deficit of 3%. That's it. There's a hard stop. They can't spend more than that because the RBI will not allow them to borrow in the market if they become too profligate. So they've reached there. So I think spending from here will not be as high as 45% year on year. It will be lower, in line with nominal GDP growth, which is about 11% year on year.
Okay. Taking a step back, I wanted to ask you, how much do you think the interim budget sets the tone for what we can expect in the full budget when it comes in the summer of 2024? And also, the stock-taking exercise by Finance Minister Nirmala Sitharaman, in a sense, it partly felt like a 10-year economic report card as well, if I can call it that. Again, both of those things, are they sort of setting the tone in any particular way? And if they are, what is that tone?
Yeah, look, I think, if the same government were to come back in a similar form, then the budget could be quite similar. If you just dial back 5 years ago, it was something similar. We had an interim budget. After that, we had the final budget, and they both had, same and similar characteristics. So characteristics like fiscal consolidation should be taken seriously, capex should be increased, subsidy bills should be over time lowered or improved. So I think all of those will be key characteristics that continue. I want to just take a step back. I think this government has made it very clear in the last couple of years, particularly in the pandemic period, that they think about spending in a very different way. They don't want to do so much of social welfare scheme spending. Rather, they would do capex, and via capex, they do social welfare scheme spending. So rather than giving more money in terms of PM Kisan or Narega, they would rather create construction job opportunities and provide incomes from that route. And I think this is, one of the ways this government has functioned over the last couple of years. And I think this should be one of the ways it plans to function over the next couple of years, given all its plans on infrastructure build-out.
Was there anything that was missing in the speech, in the document, that had you raising an eyebrow?
Actually, there was something that was missing, and I'm really happy it was, which is increase in import tariffs. Now, what has happened in the last couple of years, I've noticed in the last 5 years or so, every single year we end up increasing import tariffs on a bunch of goods, 30 to 40 goods every single year. My sense has always been that this can actually increase the cost of production. Like if there's a lot of things you import and then you use that to make something bigger and better and then you sell it, if your cost of importing goes up because of import tariffs, then when you value add on it and you export, even that becomes expensive. So in a way, import tariff has acted as a tax on our exports. And I was very happy to see that there were no new announcements on import tariffs on budget day. In fact, the finance minister said categorically that please note and please notice that we are not increasing import tariffs on any goods. I think that is very important if India really wants to enter some of these supply chains that are getting rejigged around the world, and grow competitively for the next couple of years.
Well, the naysayer in me says, well, we'll have to wait till the full budget. They still have time to make some moves on that front. But, point taken when it comes to import tariffs. The fact that the export environment for India per se is not a thriving one, and I say that on the back of the weak global economic outlook, is that an area that deserves special attention that perhaps hasn't come through, or maybe we just have to wait till the summer for the full budget to see if, additional measures are required to support both merchandise exports, maybe even services?
Yeah, to be very honest, a budget can't do too much in supporting exports. At the end of the day, your manufacturers and service providers have to be competitive. It's hard to sort of grow your merchandise and goods exports dramatically at a time when global demand is weak. But I would say here that India is gaining global market share in the exports of some high-tech products like electronics, drugs and pharma. A few of them, not too many, but a few of them, India is sort of, gaining global market share. But I think what's more exciting than goods exports is services exports. And that's an exciting story to be told. In the 90s, we were the call center. In the early 2000s, we were the software solutions exporters, software solutions providers. But today, we are an exporter and a seller of all kinds of professional services. HR, legal, medical, design, R&D, because we have all of that skill set. And India is one of the few countries in which one room you can have a lawyer, doctor, chartered accountant, and thousands of each. So what has happened is that suddenly after the pandemic, a lot of MNCs have outsourced their services from their headquarters to their global capability center in India. And professional services exports have been growing at a dramatic pace, 30 to 40% year on year last couple of years. Actually, in the last couple of years, they've, given India $60 billion more of revenues every single year. So I think the exports of services is also something that is to India's strength.
Well, I'm going to leave it at that. Pranjul, it's always a pleasure to talk to you. And I hope we're going to be able to have these conversations more frequently here on NDTV Serious Business. Appreciate your time and insights as always.
Thank you for having me.